cryptocurrency to tech stocks, markets have been hit with some swift and brutal downturns as of late. At the same time, the share prices of many value and dividend stocks have been unperturbed, and some have even gone up. However, even the best stocks oftentimes find themselves being dragged down by a broad market crash, which history suggests could happen soon. Dividend stocks are often profitable, time tested, and have clear long term outlooks. They're beacons of profitability for investors, and they're the perfect place to consider putting your money to work when a stock market crash strikes. Here's a look at three of the best dividend stocks as crash protection. Let's get to the video. Time tested dividend stocks are the perfect place to put your money to work if volatility picks up. Since the end of the Great Recession, growth stocks have pretty much left everything else eating their dust. But pan out over the very long term, and you'll see that dividend stocks are the real money makers. The great thing about dividend stocks is their payouts help to hedge against this inevitable short term downside in equities. And as noted, these are usually time tested businesses that aren't going to be disrupted by economic hiccups. Number 1. Johnson & Johnson. What makes Johnson & Johnson so special is the company's three puzzle pieces working in unison. For instance, the company's consumer healthcare products division is slow growing, but it provides highly predictable cash flow and strong pricing power. There's also J&J's leading medical devices segment, which is growing modestly at the moment, but is positioned perfectly to take advantage of procedures as the US and global population ages. Lastly, J&J generates the bulk of its growth and margin from pharmaceuticals. On the flip side, brand name drugs have a finite period of exclusivity. All of J&J's segments have worked together to deliver adjusted operating earnings growth nearly every year over the past 4 decades. This is also a good time to mention that healthcare stocks are highly defensive. No matter how well or poorly the economy is performing, people get sick and need prescription medicines and medical devices. This provides a baseline level of demand that investors can count on from J&J. The icing on the cake is that J&J has increased its base annual payout for 59 consecutive years. You can pretty much count on two hands how many publicly traded stocks have a longer active streak of increasing their base annual buyout. Suffice it to say, Johnson & Johnson's 2.6% yield and its predictable operating model can, pardon the pun, pay dividends during a stock market crash. Annaly Capital is a mortgage real estate investment trust, or REIT. Without digging too far into the weeds, this means Annaly borrows money at lower short term lending rates and uses that capital to buy assets with higher long term yields. The difference between the high long term yields and the low short term borrowing rate is known as the net interest margin. The wider the net interest margin, the higher the profit margin for mortgage REITs. Also, since REITs avoid normal corporate income tax rates, the wider the net interest margin, the more shareholders are going to get paid in dividends. What makes analysts so intriguing right now is the pace of the U.S. economic recovery. In the early stages of a recovery, it's normal to see the yield curve steepen. For example, long term Treasury bond yields rise while short term bond yields flatten or fall. When this happens, analysts' net interest margins widen. In short, we're in the period where mortgage REITs perform. To make things even better, Annaly Capital Management almost exclusively buys agency backed securities. Agency assets are backed by the federal government in the event of a default. This added protection does lower the long term yield Annaly nets on its purchases, but it also allows the company to use leverage to its advantage to pump up profits. For the past 2 decades, Annaly has averaged about 10% annual yield. That would go a long way to partially offsetting a short lived cash or correction and calm investors' nerves. Number 3. Duke Energy. If you thought healthcare was a defensive sector, you haven't seen anything until you take a deeper dive into electric utilities. That's because virtually all homeowners need gas and electric service, and demand for these services don't fluctuate very much. This cash flow predictably is a big reason behind the juicy yields electric utilities pay their shareholders. In Duke's case, we're talking about a 3.8% dividend yield, which nearly triples the 1.3% of the S&P 500. The most exciting development for Duke is the $58 billion to $60 billion it's outlaid for mostly renewable energy projects between 2020 and 2024. The company has suggested it'll up its infrastructure spending on clean energy to between $65 billion and $75 billion for the 2025 to 2029 period. While costly upfront, these renewable energy projects help to drive down electric generation costs, which in turn will boost Duke's compound annual growth rate. It'll also help the second largest electric utility by market cap stay ahead by any green energy legislation that might come out of Washington. Investors should take note that Duke's traditional utility services, for example, those not powered by renewable energy sources, are regulated. Some folks might see regulation as a pain in the behind. For instance, Duke can't simply pass along price hikes whenever it wants. However, regulation by state public utility commissions also means no exposure to potentially volatile wholesale pricing. Again, it's about cash flow predictability. Duke isn't going to knock anyone's stocks off when it announces its operating results every 3 months, but it will be a steady rock in investors' portfolios if stock market volatility picks up in any way. We all know that market crashes are inevitable, occurring on average every couple of years. While it's impossible to know what the future holds, dividend stocks might just be the crash protection you need. With that said, thanks for watching. Leave a like if you enjoyed the video and subscribe for more videos on the top best stocks.